Kia ora and welcome to the session on Tower. Thank you very much for joining us today. My name is Blair Turnbull. I'm the CEO for Tower.
And my name is Paul Johnston and I'm the CFO for Tower. 155 years in operation in New Zealand, 150 years in the Pacific, 25 years listed on the NZX. What else can we say about Tower?
So you look 155 years young, which is nice. And we've been listed for 25 years. Our anniversary birthday is coming up later in September, which is pretty exciting. We're looking forward to that. But look, Tower is very, very clear about what we do. We want to be the leading insurer down under in New Zealand and in our chosen markets in the Pacific. We're very, very focused on personal lines. That's your home, motor vehicle, boat, cat, dog, as well as small to medium-sized business insurance. We differentiate and lead out on customer experience by leveraging technology, data, and of course, our people.
That point about customer experience is really key for us, right? How do you feel that's such a key part of our strategy?
Customer experience is at the heart of everything we do. We realised some time ago that our way to success wasn't by being a smaller, different Aussie insurer. It really was embracing the communities that we operate in both New Zealand and the Pacific. In both those two areas, we know that we get earthquakes, we know that it rains a lot at times, and therefore people really embrace and value insurance. It might surprise some people to know that New Zealand, in fact, has the highest level of insurance penetration of any OECD country in the world, which makes it an attractive insurance market, but also something that we do have a lot of. Now, unfortunately, the flip side to that is that 2/3 of customers don't fully understand their insurance. So they know they need it, but they don't fully understand their cover. And a key mission that we have at Tower is to make that insurance experience very simple, very rewarding, and fair and transparent. And that's in everything we do, whether it's online or over the phone or helping people with their claims. And we do that again through technology and data and first principles about being very fair and transparent. So on that note, I've talked about pricing a little bit there. Why don't you tell us a little bit more about our first principle of something that we call risk-based pricing?
We've got risk-based pricing at the heart of everything that we do, and we display it very transparently for our customers as well. And we feel that gives us a real industry-leading advantage. We have earthquake and flood risk-based pricing at an address level. Actually, it's the centre mass of the property. So we've mapped every property in this country at a location level, and for each of those individual locations, we give an earthquake and a flood risk rating. And as you said, we are transparent with our customers, and so we actually display that. For every quote or renewal that our customers get from us, we give them their risk rating very, very clearly. In addition to that, last year we also expanded that to sea surge and landslip, and so at the moment that still sits in the background and informs our underwriting. That's really a key differentiator for us, risk-based pricing, when we talk to our reinsurers, but also, as I keep saying, when we talk to our customers. The other thing that we feel is a good advantage for us is our platform. By being a digital insurer, we're able to actually really leverage our ability to price and price very selectively. We'll do up to 100 price changes in a year, and we're able to really jump on key trends and make sure that we can give our customers the best price if they've got the best risks. And stay on top of our pricing there. And so all of those put together means that for the last 3 years we've been able to grow our GWP at a CAGR of 15% while actually improving the risk profile of the book. So pricing is really key for us.
So look, just to recap that, we do lead out with customer experience. At the heart of that, a first principle for us, as Paul said, is right risks, right price, and managing that margin. And we do that through risk-based pricing, and we bring it right down to a household level. And we believe that gives us a competitive advantage. Also important, and a key part of our strategy for Tower, is around having a very streamlined business, a business that is very operationally efficient and is also digitized in today's world. And we've invested heavily in technology over the past years to get our digitization and online experience right. Around 80% all of our new business is done online. More than half of all of our transactions, service transactions, are done online, and around 1/3 of all of our claims are also done online. But we recognise if someone has water up to their knees in their basement, they'll want to talk to someone, and we're very quick to pick up the phone. And that's helped by having an operations centre in Suva where we have over 300 staff. Those are our tower people who can pick up the phone on a very quick turnaround. And that's something that we've introduced in the last few years, and it's gone very, very well for us. Not only is it good for our business, but it's also supporting the communities where we operate in the Pacific. So Paul, a big part is customer experience, a big part is risk-based pricing, but also we are in the business of risk. Remaining very resilient is really important to any insurer, particularly tower. How do we do that?
Key for us really obviously is to make sure that we can continue to increase our profitability and improve our solvency position. We do that through top line as we've talked about, but we also do that by improving our management expense ratio as well. And so, as you mentioned, Blair, digitization and technology is a key part of what we do. We've also really looked to simplify the business as well and stay really focused. So, we've exited some of our non-core markets in the Pacific, like PNG, Vanuatu, Solomons. We have also sold our rural book. We've bought back legacy bank books as well. So now those are tower customers. We have our partnership business, which is a referral-based business primarily, and so that means that we're paying an upfront referral fee, but we're not necessarily looking at trailing commission there. And so all of those, along with that digitization, has enabled us to really improve our management expense ratio. While we do continue to grow our absolute cost base, we grow it a lot less than we've been growing our top line. And so as a result, our MER ratio, which is fundamental to our profit as well, has really fallen. That's enabled us to grow our profit quite significantly and therefore improve our solvency position. And that improved solvency position and staying above our target solvency margin just enables us to be resilient in the face of a catastrophe or disaster. But in addition to that is our reinsurance program. So we've put a lot of time and effort into managing our reinsurance program. And our reinsurers love our risk-based pricing approach and our approach to risk generally. And so as a result of that, key metrics which we do look at are about price, retention limits. Those are now in line with our much larger and globally diverse competitors. We feel that the way that we've set the business up really does give us a competitive advantage in reinsurance. And you combine all that and along with the fact that this year we've got a 45 million large events allowance, and next year we'll grow that to 50 million. And so, we feel like we're in a really strong position to be resilient in the face of whatever Mother Nature can throw at us.
So capital strong, good solvency, and a very robust reinsurance program, which is insurance for insurers. So looking just in summary, we may be 155 years young at Tower, but actually we're a very modern business now. We've invested heavily in technology, in digital, in data, and our people both in New Zealand and in the 5 markets that we operate in the Pacific. At the core of all of our success in the business, where we focus forward, is around the customer experience. It's bringing, we know as Kiwis, we know as Pacific communities that we need insurance. We do get shakes, we do have weather events, we value insurance, but we just don't always understand it. And we're looking to make that really simple and rewarding through our customers, through digitisation, being very operationally efficient, streamlining our business, and being very resilient with our reinsurance program and our capital management and risk management. That's where we are today. As we look forward, the strategy remains very focused. It's just more of the same and doing it particularly well, continually looking for improvements to drive efficiency, to drive through on that really beautifully simple customer experience, and to further strengthen our business as a whole through reinsurance and the like. So what you can expect looking forward is more of the same, a very focused business, and I think that will set us up for success.
Tower's recently announced a really important announcement for our shareholders, actually, and it's made up of a few different parts. We've guided the market that we're looking at a 5-cent final dividend, which will be 8 cents in total for the year. We've also announced a capital buyback for our shareholders of $45 million, obviously subject to to the required approvals. And also, and really importantly for us in our ongoing business, is a reduction in our license condition from 15 million to zero now. And so, that license condition was something that the RBNZ put on us following the Canterbury earthquakes, and it started off at 100 million, and now we've through everything we've done around improving our capital structure and our resiliency and our risk management processes, that is now down to zero. And so, the sum of all that announcement, we think, is a big positive for our shareholders. Absolutely, yes. Reinsurance is critical for us. It's critical for our resiliency. We, like every other insurer in New Zealand, we're required to buy cover for a 1 in 1,000 event. So this year that's looking at $750 million. Looking forward, it'll with the growth in the business, it'll be higher than that. And so we buy a very robust reinsurance program that protects us from multiple events. And then in addition to that, we also have our large events allowance next year of $50 million, which again has grown from this year of $45 million. And so the combination of those two mean that we're well protected in the event of a large catastrophe next year.
So certainly climate change is not an if, but how fast and how big really. And certainly Tower recognises that, and we're responding in a number of ways. Three of those big ways that we are responding to climate change is firstly helping our customers and communities understand climate change and how it impacts them personally and their homes. And we do that through clearly showing to customers their risk profile of their home for earthquakes and weather events, slips and coastal inundation. And that supports our first principle that Paul talked about previously around risk-based pricing. So helping customers firstly understand climate change at a personal level is really important. Secondly, it's having a really robust reinsurance program. So when those big weather events and catastrophe events do occur, we can respond very quickly and in a capitally strong manner. And that's what reinsurance provides for the likes of Tower. Thirdly, we can also innovate for the future, a better future. And we're doing things like parametric insurance, which is insurance at a specific parameter, for example, wind or rain precipitation. And it's providing insurance that is affordable for communities that don't or won't typically get insurance in the future. So those are communities in the Pacific in the face of rising sea levels and increased frequency around cyclones. We're working with the UN and a company called Celsius Pro, a global leader in parametric, to develop a new platform that can provide basic levels of insurance cover for those communities, which we're pretty excited about, and we launched a few years ago and will continue to roll out across the Pacific in the coming months and years.
What makes me most proud to work at Tower is Kiwis protecting Kiwis. We are New Zealand's only listed insurance company, and our mission is to protect New Zealanders and our Pacific customers as well from whatever the world can throw at them. So we are there as a backstop for our customers whenever they need us, and that does make me proud. And remaining resilient and being here for the long term for our customers is what makes me proud.
And in terms of most excited, I'm particularly excited about what we've achieved over the last few years as we've really led out with the customer experience and digital and data and technology and invested in our people and our platform. But as I look forward, it is going to be more of the same. But also, we believe we can do some really exciting things in the small and medium-sized business market where we feel there's an opportunity to bring some of that technology through as well. I think also exciting innovations in the Pacific and communities that haven't had the benefits of insurance in the past. We believe through the likes of parametric insurance, we can make a difference for future customers and communities. Also, I feel excited about what we can offer investors as a business that is very proudly New Zealand and Pacific, and a business that is growing and investing in technology and is investing for tomorrow. And I think that's exciting to have those opportunities for investors of New Zealand.
Hello there, I'm Alex Crook, the Portfolio Manager for Bankers Investment Trust. Bankers Investment Trust is a global investment vehicle primarily investing in equities in all markets across the world. And our prime objective is really to generate a capital return in excess of global indices, but also to produce an income in terms of dividends that grows quicker than inflation, so produces a real return over time. Our portfolio is managed by a pool of experts, 4 investment managers who really intimately know their markets, primarily because they're based in those markets. So our Japanese portfolio is managed by a manager in Tokyo, our US portfolio managed by an investment manager in Denver, USA. Our European and UK portfolios are managed out of London, and finally the Asia markets are managed out of Singapore. These experts really have very long experience, 20 years plus each, of investing in companies in these regions and really truly understand the markets they invest in. My role is to sit over the top of those managers and really try and manage the investment risks and also the capital that we deploy in different markets. So I have the ability to move capital between the US into Europe, into Japan, for example, and really trying to seek the best returns out of those regions and the stocks we own. When thinking about our investment process, how do we actually find interesting investments? I think I always like to say we follow the cash. And really what we're trying to say there is we're trying to generate, not in companies that are very early and therefore maybe prone to risk of failure, but companies that are a little bit more mature, but really are trying to generate excess amounts of cash. And really that cash allows them to invest in new products, it allows them to invest in new factories, but also to pay us dividends over time that should grow, and also to pay down debt that they may have taken on earlier in their life. So I think by following these cash generative companies and critically not overpaying for them, trying to make sure there's good value in the investments we have, really should create a sustainable return over the long term. Our portfolio has, for the long term, always produced a capital and income return. But markets are always changing, and we've been looking recently at enhancements to our process to try and improve the consistency of the returns we generate. So the portfolio still remains truly active. In this sense, we sell stocks that we think are expensive and we buy new investments that we think represent better value and better opportunities in markets. So our portfolio invests globally. We have 4 key portfolios that invest in all markets of the world. First of all, the US market, which is the largest region of the world in terms of equities, but then a portfolio covering the whole of Europe, including the UK. We then have a portfolio in Japan, and finally a portfolio covering Asia and emerging markets. These portfolios are managed in a truly active way in the sense that we try and seek maybe 20, 25 stocks in each of those portfolios. So these represent our best ideas, trying to focus the capital we have into the best opportunities in each of those markets and not trying to buy every stock in the region. Index funds hold thousands of stocks, but for bankers you're really getting our best ideas in a concentrated portfolio of roughly 100 stocks. Our portfolio is more concentrated than passive index funds and can't be replicated by holding a collection of those investments. We're also much more concentrated than many of our peers. But I think this concentration is really focusing on opportunities that we think will produce returns over the long term. Obviously, markets produce different income returns and dividends, but investment trusts have the opportunity that in the good years they can build excess income into revenue reserves. And the board have very much indicated that they see this as a flexible opportunity to invest in markets maybe that are lower yielding, such as the US or Japan, at times when we see the opportunity to be in those markets. So you will see us over time, I think, flexing the income and using the substantial revenue reserves that bankers has to smooth the income over the long term. So what is our asset allocation and outlook for the medium term? Well, so let's start with Asia. And in Asia, we've combined our Chinese onshore investments, these are called A shares, much more localized local companies into our wider Asia region. And we think this is the right time to be doing this. Our focus in China has always been about the consumer and trying to find opportunities that benefit from increased consumer spending. But I think with ongoing issues around the property market there, and really the government trying to industrialize the economy, I think the opportunities there are less obvious. We keep some of our key investments. We're probably holding around about 5 or 6 names, local names in China. But I think the wider Asia region is much more interesting to us, particularly markets like India, where we see now a stable government for the next 4 or 5 years, and we see good investment opportunities in that market. Again, the consumer is getting more wealthy, and we're seeing wider consumer consumption spending going through that market. We also very much like the semiconductor story coming out of markets like Taiwan and Korea, where we see good opportunities for capital to be reinvested in new opportunities there. In terms of Japan, we also like Japan as a market. We're overweight in the portfolio. And again, Japan is undergoing some interesting changes as interest rates are slowly, very slowly rising from a very low level. We're also seeing inflation coming through the system, higher wage payments coming through, and we should see consumption spending increasing. So again, in our market, we see interesting opportunities on a relatively very low valuation compared to its history. We're moving more towards Europe. We again have combined our two portfolios in the UK and in the mainland European region into one. And really this is allowing us to focus on maybe the best banks, the best pharmaceuticals, the best consumer stocks in a wider region rather than focusing on one country or one area. So again, we see opportunities in Europe, I think a little bit more challenging because growth is slower in that region and we're coming out of a period of problems with high inflation and consumer spending being restricted. But actually share prices reflect a lot of that. And so we are beginning to see some upgrades to earnings coming through. And we see therefore some opportunities as those upgrades come through for the shares to appreciate on the back of that. But really we're having to be selective in Europe. I think some regions like financials look good to us as interest rates stay higher for longer in that region. And so we're focusing really on smaller sectors to increase our opportunities in that market. Finally, we return to the US market, the largest in the world. And really this market's been dominated by artificial intelligence and technology investments. And we see that leadership beginning to change over the next year or so. Not that those companies will do badly, they're continuing to produce very good results, but we actually see the rest of the market beginning to catch up in terms of earnings growth and investment opportunities. So we see interest rates slowly coming down. The US is in a pivotal year with a key, obviously, election in November, whether Republicans or Democrats will get in. And we should be seeing finally interest rate cuts come through to stimulate the market. Now, whether those will be quicker than expected or not, we'll have to see as time goes on. But we should see the leadership in the market begin to change as some consumer areas, particularly financials as well, begin to take over, I think, from some of the technology stocks. So it's not a focused market. We actually are trying to expand some of our opportunities. We've been buying into pharmaceuticals, we've been buying into financials and reducing some of our technology exposure, but keeping some key names within the portfolio. If you'd like more information on the trust or updates as time goes on, then follow us on our website.